So for those that don't know, my name is Rob Chevez. I'm one of the facilitators of CAZA Reston, right? We now have 16 chapters in 8 states all over the US. We have 16,000 members. We've got a lot of successful people running grids all over the country, and our vision is to have 500 plus, right? To build a network of hyper local specialists that are experts in their backyard, and we share and collaborate. What makes us different than a RIA is that typically RIAs are always selling something in the back of the room. There's no selling here. This is masterminding around doing deals. We're deal makers. That's what we do. And we believe in being go-givers, coming from contribution and giving you all the information, as much as we know, right? The good, the bad, and the ugly, so that you guys can go out and do deals with each other. So the way we've always liked to start off this is just a quick little brief intro of who's in the room right now, right? So that you can maybe afterwards, after we get done, talking a little bit about our topic tonight, you guys can then meet each other, exchange business cards, do what we've always kind of done in the past. And if you're new, just say, hey, I'm new. If you do multifamily, say I do multifamily. If you're a hard money lender, say multifamily. If you bought 52 properties this year, like I'm not as to say, you say I bought 52 properties, right? So we're gonna kind of go through those things, and you get to learn who's in the room, right? So Mr. John Beal, how about you? Let's start with you.
All right, John Beal. I used to work with Rob at Keller Williams many years ago, but I'm a real estate apartment owner. We do syndication deals, and yeah, look, I'm happy to be back out in front of people, and I'm a little overdressed, I guess. But
I said casual.
Hey, the first one, I ran this through the washing machine, and ready to go.
Good. Well, John and I, I was a brand new baby to this, but like 15 years ago, I think is when you and I met. And he was running investment groups, right? We were part of
Yeah, we had a RIA.
We had a RIA.
We were selling things.
Yeah, you were selling things.
That's so old school.
That's right. And then you did a commercial RIA,
Yeah.
right? You did a commercial
Right.
RIA. So him and I were talking about apartments. I was like, dude, we got enough discussion about apartments tonight. So come on down, let's talk. And and you brought your business partner.
Yes.
AJ, go ahead.
Yeah, I'm AJ Fraser with the Community Investment Partners. So I'm a partner here with John, and finding good units, trying to give them good prices, syndicate them, and gonna build a little money train here. So
Awesome. Welcome. Go ahead.
Hello, my name is Amir. Nice to meet you all. So actually, I'm new to real estate, but my friend invited me this awesome group. So I just want to know you guys' experience and wisdom. So I'm ready to get educated today.
Awesome.
Yeah.
Welcome.
Thank you.
Go ahead.
I'm Roger Wilmot. Not new, I've been to the group a couple times, virtual a couple times. I have a handful of rentals that I manage from here down to Richmond. Looking to expand the portfolio, go into more multifamily, more into the commercial side potentially. And yeah, looking to learn.
Welcome, Roger.
Thank you.
Go ahead.
I'm Mike Casey, investor for about almost 20 years now. Anything that has a roof over it, I will look at it. I specialize in buy and hold, long-term rentals, a little bit of short-term rentals. You mentioned I have a big goal this year of closing on 52 properties. I'm at 39 this year. I got bored during COVID, so I needed a goal to push me. I don't normally do 52. My wife thinks I'm crazy, but it's working. And buy and hold rentals is what we focus on.
You bought 32 this year, right?
39. Just closed on 39.
That's
Yeah.
ridiculous.
What area?
All over. So I'm from Hawaii. So anywhere between Hawaii and here, I'll purchase. Here in Virginia, I do a lot in Winchester, Front Royal area. I do pockets in Maryland. I'm breaking into North Carolina, a little bit as well in West Virginia. So
Well, we're gonna be looking to you for some insight today on just like how you got about finding deals was difficult, right?
Yeah,
Let's talk about that. So, part of this is learning this, but it's how to find these deals. That's important. So welcome. It's good to see you. By the way, his wife used to work here.
yes,
Like 13 years
probably,
ago, something
yes.
like that, right?
When I was still in Hawaii, she came up without me. And, got settled, and she actually worked.
Crazy.
And she hasn't worked since.
She's been working.
She's done.
And you were the broker for White Girl?
White Girl, I'm allowed in office, yes.
Awesome. Yeah, and excellent reputation in the marketplace, so welcome, man,
Thank you.
good to have you.
But Cal Williams is better.
No, there's no better, right? There's no better. It's like, what I love about what we do here at Grid is that it's brand agnostic, right? Like, we're here to do deals. We're deal makers, so, you know, it's just different. Keller is different than Weichert, and Weichert's different than EXP, and
I like to say I'm a non-denominational investor. I will
Yeah,
invest with
yeah.
everyone, right? That's what it is, right? It
we
changes.
are our own tribe,
Absolutely.
We
right?
take cash.
Yes.
Yeah. Go ahead. Introduce yourself.
Oh, hi, I'm Richard Chan with RMC Capital. I do commercial mortgages, primarily HUD, so I thought this is an especially appropriate meetup here.
Perfect.
I do HUD, Freddie, Fannie, conventional, small balance, and then I have some other programs too. So if anyone's interested in HUD loans, I can tell you all about them. Great rate, I think I posted on your website, 2.6 right now,
Yeah, crazy.
35-year fix,
Wow.
85 LTV, non-recourse.
Okay.
So.
All
there
right.
are
We have some
nuances
slides
here
for you.
now.
We be prepared to speak again.
Sure, and I know you were asking about finding deals and things like that. Well, part of my thing is I'm pretty much networked with a lot of people that keep their properties for about 7 years, and after the 7-year accelerated depreciation, they're ready to sell. So I'm pretty much networked with a lot of people buying, selling, things like that, so I can talk to you about that, and I can also lend across the country.
Powers of the
Right.
network.
We will
Powers of the
connect.
people you know.
I'm
Go
sorry,
ahead.
How many people do I know?
No, I said the power is in the people you know.
Oh, yes, right, exactly.
Powers of the people you know.
The Rolodex and the, right.
We're glad to know you. Yes, sir.
Yeah, I'm John Cassidy. I met Rob years ago. He helped me with the house sale, and I'm newer to this. I do have a few short-term rentals and so forth, but I just want to be here to learn.
And John's a badass fitness person, right? And you, well, at one point you were well, you are still probably a master Taekwondo.
Yeah, we have, I have martial arts schools in the Northern Virginia area. We have the top kick brand and so forth.
Yeah, very cool.
A little bit of everything, but that's been a passion with the martial arts. My wife and I do healthcare to martial arts, but just we have a beach property that's a short-term rental. We're babies in this, but been following Rob for years and just curious about this network.
Yeah, and real estate's such a great wealth building tool, right? That's why we do this.
I did the one thing in Austin years ago too, the retreat with Keller Williams, which was really cool.
Good stuff. Blair, go ahead. Introduce yourself. Yeah.
I'm Blair. To piggy off John, this is my first time coming here. I've known Rob for several months and it's been great and fantastic for me. I work for the Dwellers team here in the office. There's a familiar face. So this is the first day. So
Awesome. First day of the rest of your life, man. That's how it works. Actually, super successful first year in the business. You did 18 million. What'd you do?
I did just a little under 15.
Yeah, so
Wow.
great. That's a lot of business for somebody first year in the business. So congrats. Right. Go ahead, Mike, introduce yourself.
I'm Mike. I currently work for Rob at CAZA. I'm an agent now. I got licensed about 6 months ago. I got interested in I've always been interested in investing, but it was primarily stocks and stuff. About a year ago, I got more interested in real estate. I participated in a couple of flips with a buddy of mine, bought my first rental, and my focus is really buy and hold now. And that's the direction I'm going.
And if you want to know all things crypto, that's where you go.
I like crypto.
Come on in, sir. Take a seat. Go ahead. Who else? Introduce themselves.
Jad, say what's up.
So my name is Jad Sarsour. I've been coming to Rob's Lift since I can remember. I used to drive 45 minutes just to get here. Luckily, that I made enough money that now I live in Oakton, and so now my commute is 6 miles.
Yeah.
A very active flipper, but I do a lot of buy and holds. I'm up to about 130 units between my brother and I. We just bought 2 new buildings in Front Royal, all cash, probably beat you out to
Nice.
this. And I just bought 4 new houses in Stafford that in 1 month, and I'm in the process of refinancing out of it. It's exhausting now, so I'm trying to get to buy more portfolios, because buying one and refinancing BRR is exhausting. So
Yeah, but there's no easy way.
there is no easy way.
Yeah, it's all work. Right, but it's fun
So,
work. It's a game.
It's not fun work. I just wired $30,000 to my contractor. I bought this house sight unseen. It's not a good idea.
Go ahead, sir. Introduce yourself.
Me or you?
Both of you, either one.
I just got here. Oh, yeah, my name is Hamza Rashid. This is my second event. I'm a corporate lawyer. Yeah, looking to get involved in real estate. You know, trying to see what the market is. I understand it's, yeah, it's about apartments. I think it's pretty hard to get an apartment building. I just wanted to see what your guys' thoughts are. Yeah, pretty impressive growth from the last meeting, so it's good to hear what people have to say.
Come on, welcome. Go ahead.
Hi, I'm Sean Rooney and I live in Love County and I'm a new apartment investor. I'm in the process of looking for opportunities to purchase soon.
Okay. Welcome. Skylar.
Okay, I thought there was too much guy energy in the room, so I joined. Break it up a little bit. I'm Skylar. I'm on Rob's team. I've been with his team for almost a year now. So I like jumping in here and seeing what it's all about.
Learning. There's another crypto girl right back there. It seems like we have crypto people. Bex, introduce yourself. You're the last one.
Am I going last or we're gonna chat with the international?
No, that's okay.
Now we're just gonna let them follow along.
They follow along.
Good.
Yeah. You gotta
No,
go.
we love you. Still, please, if you really wanna get to know people, come to the room.
Yeah.
As I said earlier on Facebook, if those who are watching, hi, everybody, I'm Mark Stack. Rob and I've been doing this since 2009. Because it works, that exercise that we just went through probably let you know that there's people in this room who are buying stuff, who have money, who are looking for portfolios, or maybe looking for partners. We are also all of those things. I run our construction company that does the renovation work on our portfolio properties, does work for our clients, occasional third-party work, so anyone ever needs that kind of service. Please do let me know. Always looking for deals. Anyone has anything that they would want to wholesale, sale, partner on? Always interested in those opportunities as well. We would love perhaps some commercial real estate of our own. So if anyone knows anyone who's got a building for sale in the area, we would like to maybe move this operation to an owned space that we can kind of
5 to 10,000
modify.
square feet.
5,000 to 10,000, couple of
Industrial,
floors,
big,
commercial or
glass,
industrial or
concrete,
retail.
like, yeah, we got a vision of what we want, so.
Just imagine doing this in a much cooler looking space. Help us find that space and then we have a much cooler place to do this in, right?
Yeah.
Looking to purchase,
So,
Yeah.
look to purchase, yep.
and
So
what,
anyone-
what area?
DC, what am I talking about? Reston, Vienna,
Preferably within 5 miles of where we're sitting. He's a quarter mile away, I'm a mile and a quarter away. We would love it to be close to us, right?
Yeah.
So, that's the preference. So if anybody knows any of those things.
So we put things out to the universe, because that's just kind of how it works, right? Somebody who knows, somebody might know somebody that's thinking about selling something, right?
the other things we put out into the universe is people. We're always looking for people, right? Rob can talk to anyone who'd like to know what a powerhouse real estate team can do for you and your life and your income. Anyone's interested in construction, please talk to me. We're always looking for project management.
Yeah, we're looking right now for 4 inside salespeople.
Inside sales, we need inside sales, we need project
Project
management on the
manager for
construction side,
construction.
sales on the construction side. So we need human capital also, if anyone ever wants to connect us with anyone, we greatly appreciate it. And then, of course, you want to connect with us, that's why we're here, right? Grab a card, follow up, grab coffee, talk about what the rest of your business looks like and where we get slotted. That's kind of what we're trying to do.
And tonight we're talking about apartments,
Correct.
multifamily properties.
We are
apartments.
here as the all-knowing gurus of everything apartment.
Definitely not.
So please do
Yeah.
everything we say,
So this is what we.
or read this, and this, do nothing that we say. Everyone on the internet knows that this is not an accounting exercise, nor is this a legal conference. We're just talking about stuff,
We're
right?
talking about deals, right? We own multifamily properties. I've owned multis, smaller multis for the last 15 years. I know the good, the bad, and the ugly. I'll share experiences of what I know. But this is really a discussion. It's a mastermind. So we ask for your input on things as we kind of go through and we start talking about different topics. This is a discussion. This is a collaboration. That's how people learn. And don't be afraid to ask a question. There's no such thing as a silly question. Listen, I came to investment groups for years before I ever really made a move. 99 to 2002 or 2003, I was a fly on the wall, just kind of like learning and buying onesie twosies along the way, so I know what it's like, right? So feel free to just ask questions. This is a safe, like, pro question place, right? So we're gonna talk about a topic tonight, and I'm gonna kind of turn and ask some people that have experience in this about what they do and what they see, right? But before we get really into the nitty gritty, let's talk a little bit about, because I think it's always important to talk about where we are in the market, right? So for those that are experienced right now, where are you? What do you see in the market? What are your fears? What are your, or maybe you're not, maybe you're just like, hey, this is all good. Amar, what are you thinking? You're probably studying the market right now.
Yeah, I think more than ever, we have to be, have more tools in our tool belt to be creative, because not everything on the market, most don't work. If you're saying, I just want to buy and hold, most doesn't work, or I just want to burr, that doesn't work for everything. So you almost have to have several options to choose from, because most properties, if you look at it the right way, you can make something work. It just might not be what your lane is there. So it's figuring out to do more deals. You got to kind of be flexible in what your approach is. Market wise, it's a lot of off market efforts. Either there's some MLS stuff, but it's a lot of off market efforts to get there.
That's right. It's competitive, still competitive. You guys should be looking at inventory levels and researching inventory levels, right? It's gotten a little bit softer. I was pulling inventory this morning in Reston. There's 117 active listings. Of those listings, there's only 8 active houses, single family houses. There's something like 20 townhomes, and the rest are all condos. So the condo market is pretty flooded in Reston, right? Talking to somebody else that said condos in DC are suffering right now. So every market has its own like little, ecosystem, and you guys need to be tracking that. And what I like about real estate is very different than like the stock market, but where, it could fall very quickly. Here, you can see the trend lines happening, right? And you just got to be paying attention to those lines.
So we had a big residential mortgage lender talking to us this morning. They said they had one of the best months ever recently.
That's right. And we had our biggest October ever, right?
How about commercially? What's the commercial volume like? Is that
Pretty much backed up.
backed up as in?
No, we just have a lot in the pipeline in terms of the sales pipeline, underwriting pipeline, processing.
So
So a lot of people looking everywhere. It's very competitive. I would caution people to be more numbers oriented and don't chase a property, don't fall in love with the property and don't chase it up. If it's too high, if we cannot justify it. So like one of the things that we do, you're gonna do your own underwriting, but we also do it for you too. We're gonna look at the numbers such as the NOI, the cap rate, things like that, see if it justifies the sales price. Now, we're only gonna lend to a certain level, to what we think is worth. Okay, we're just following the HUD or Freddie Fannie guidelines. So we'll do that. We'll also look at, with respect to the type of building it is or the class. So if it's a class A, B, or C. So obviously, the lower it is, the higher the cap rate should be.
and are you seeing any distress at all in the commercial building space? As potential buyers, we're driving around and there are huge swaths of Northern Virginia. When you drive through office parks, middle of the day, they are empty because no one works there anymore.
Yeah,
So I keep waiting for the shoe to drop on all of these empty office buildings, what's gonna happen.
Yeah, there's still demand out there. I mean, a little bit of demand, but in special pockets, like you mentioned, the MOB, I think is a good area, and that's medical office building. Because guess what, doctors, you can tell a doc, but eventually they'll have to go see the doctor. Doctor's still going in the office, dentist still going in the office, and a lot of lab there. A lot of doctors and people like that, eventually, they'll buy their own building, not right out of med school, but eventually they will. And they'll rent the rest of it out to, they'll occupy like one floor or one suite. Then they'll have other suites for their younger or other doctor buddies, dentist buddies, blood lab there, pharmacy. I'm doing an office building right now for a pharmacist up in Ellicott City. So he was able to negotiate a good price. He's taken down 2 of the units. He only wanted to take down 1. This is like a second office or second site for him. And I'll just tell you, I don't want to bore you with too much of the details, but he has like 1 particular tenant in there he's buying from without a lease. They've been there for 20 years. without a lease, so buying it, and fortunately, given the ultimatum, either you sign a lease at the going rate, right now they're paying about half the rate.
What I noticed is, what Ahmed said is that a lot of this is like off market. So literally, we've just been approaching owners and just saying, hey, if you're thinking about selling, we're interested in buying. And that's how you find deals, by the way, in this market. You're not gonna find them in the MLS. Think about that, like, once they're in the MLS, they're so competitive. I mean, maybe you will find them, there are exceptions to that. But for the most part, a lot of these things are off market through the network, people, they're really good deals, right? Any of the 39 multis, were they all singles or what are they? I'm curious.
So my focus has been small portfolios for mom and pops looking to exit. So anywhere between 2 property portfolios, my biggest portfolio was 13 property portfolios.
I was wondering how you do that. So,
Yeah.
Because it's like 39 individual ones.
It's hard to do in one, so I have done a handful, maybe 4 one-offs, but everything else has been in portfolios.
Okay, cool. So so we talked about how to buy portfolio property. Here we go. How do you buy a little package, right?
Do you have a hard time managing those? I mean, if you have so many different properties all over the place.
I mean, stabilizing them,
and-
yes, because not all of them are buy and hold ready. Some of them are renovation projects, but I don't property manage, so I have people that do that for me. But the first 6 months of anything is a little chaotic of getting things organized, and some sit on the back burner for a little bit until you have the crew ready to go. But after about 6 months, they're usually stabilized.
See, that's a good thing about large multifamilies, medium to large, meaning like multifam 50 to 200.
Yep.
Yeah, the condos of scale.
Yep.
Which is what we're gonna talk about tonight, right? So let's get
Love
into
it, love that segue.
Yeah,
Okay.
good segue. So we're wanting to talk about that multi-unit property investing. Just a quick show of hands. I'm guessing a lot of people in here who's renovated a house before. It's like a fix and flip, just fix it up and sell it. So good. Everyone mostly then kind of knows what that deal is, right? You buy it, hopefully at some discount to market value. You add a little value to it, hopefully sell it from what you got into it. Once you've done that though, that's it. You make what you make, you lose what you lose, win, lose, or draw. That deal is done. You got to go find another deal, right? Good way to make good money when you've got a good deal. You're exposed to certain kinds of risks while doing that, while owning a thing that needs work, while having someone else do work to it and then putting it out on the market and having someone buy it from you. But the biggest upside to it is whether it's a great experience or whether you made a ton of money or lost money, it happens in whatever span of time that it happens in, and then you kind of move it on. But that's also the downside, right? That's it. You make what you make out of this one thing, and then you've sold it on, as opposed to any kind of buy and hold of property, but especially with a multi-unit property. These are longer term investments that we believe result in greater accumulation of personal wealth over time, right?
significantly more, right? So it's the difference between being, in the S side of the quadrant, in the cash flow quadrant, Robert Kiyosaki talks about that, and going to the I, right? And you're building wealth in that process. So whether you're in construction or you're an agent or you're any small business owner, that's all earned income. And the goal is to take that income and flip it to the passive side. I mean, that's why you guys are here. One of the advantages of buying a larger multifamily property is the very thing that Richard was talking about, is you can literally have, John, you just put how many units under contract?
95.
95 units, right? 95 units in one location, it makes everything a lot more efficient. Now, there's pros and cons to that, but it makes everything so much more efficient when you're able to do that. And you got to look at that business as well. You got to look at that property as a business, right?
That's right.
Just like he's got multiple businesses in lots of locations, this would be one business in one location, which sometimes it's just easier to manage, right? Easier to manage one business in one location and then go deep on that and then do it again. So it's one of the benefits of going upscale. And I don't know if we've got like Jason Stubblefield or any of our friends in here that, they do a lot like all over the country. And Jason,
Yep.
right? He's been trying to get me to do 100 unit plus in Tennessee and other places. And I just haven't, right? Because I'm an active, investor.
But the quick upsides are presumably this is a larger enterprise, a larger business, a larger investment that hopefully then when it goes up in value, it goes up in a rate that 10% on your $100,000 townhouse makes you rent, 10% on your $1 million building, made you $100,000, right? Exponential increase in your net worth when the value goes up. Risk diversity, so as opposed to having 95 townhouses, each one of those is 95 little small businesses that you now have to manage. And you do have some diversity of risk, but a little bit better when all of the income is coming from a building and one or two of those 95 is vacant for some period of time. That's kind of easy-ish to absorb, and maybe one of your 95 single-family houses is kind of easy to absorb, but not on its own, right? You lose money on that one building if it's vacant for 6 months.
Well, if your single family house is vacant, that's 100% vacancy right there,
100%.
as opposed to a 95, one unit's vacant, and, you know, you've got the other 94 that are supporting, so, you know, there's some level of protection that's there.
And so for increasing the value of a multi-unit asset, you can massively increase the value of a larger building by making either large systems improvements or renovations, or just regular old-fashioned unit renovations. But again, you're doing it to 95 units at a time in one building, as opposed to having to finally renovate 95 individual properties.
But the real value happens when you increase those rents, right? When you increase those rents, the value of that asset goes up. And so the idea is to find typically an older, tired landlord that has not taken care of the asset in many years. They've depreciated it, right, to zero, and now they want to exit that. And a younger Rob or Amna can come in and put in the money, get those rents back up, increase the value of that asset, right?
And that was the last point there.
So we just, I just did that on, brother and I just did that on a unit outside of Manassas, 22 units. They were renting like a studio for $400. I inherited. They're not paying $1,300. And then like the 600, it went up to $1,800.
Let me tell you what's happening. This is super interesting, guys. There's a window right now, right? Rents have gone up a lot, but the older landlords that have been in the game for a long time and they've had tenants in there for a long time, they just don't want to rock the boat. So they're not going to increase those rents because the properties need a little bit of work. They don't realize how much the rents have gone up.
Well, and they want 100% occupancy.
And they want 100%.
They don't have to deal with filling in, empty
they're
apartments
tired,
and
they
stuff
don't
like
want
that, and you get their check, it still comes in. So it's not as big, but there's no headaches.
And there's no headaches, right?
So one lady had been there for like 20, like you guys were saying, like she's been there for 20 years. So I've been here for 20 years, you guys are kicking me out. I'm like, no, we're not kicking you out. Like, if you could just pay like a couple more dollars. Like,
Yeah.
Well, I think the key,
Yeah.
I like what you guys are saying, 'cause I think the key is, none of us want to be in a place where it's like, hey, sorry, you've been paying this really low rent, we're now gonna give you a place to leave or pay, pay double. You want to present value, and so, so we have as you mentioned, Don, Don is a nice 95 unit property down in Lynchburg. So the first thing, you improve the exteriors, you put $50,000 in, already the neighborhood starts looking better. You haven't even touched an apartment yet, but already people drive up and they're like, oh, that's kind of a nice looking place. But then you still go apartment by apartment as it flips, so you kind of get a lot of flexibility in the way that you can start pushing those rents up as things turn over, but you get some immediate just ramp up by just painting the curves, cutting the grass, putting in new plants. Everybody's happy, like, oh, these new landlords are so awesome, they look beautiful, and then it starts eking up, and then people empty out, and then you flip the apartments, and then you really take them up. Nice white countertops, beautiful lighting, so yeah, if you can find the right property.
You gotta find the right property.
If they're not already thinking ahead, like, well, I'm pricing in what you're gonna do to the property. Then that's.
It won't work.
Yeah.
In fact, great book on understanding the numbers is Everything You Want to Know About Cash Flow. Forget the name, maybe somebody can look it up and give me the name of the author, but Everything You Want to Know About Cash Flow. Great book, teaches you about cash on cash return, NOIs, like the whole bit, right? So very important to know those numbers. What were you?
So that was kind of the easy positives of multi-unit investing, a couple of easy to identify negatives, a little bit harder to diversify. If you own a few hundred units, you're pretty much locked into whatever the local economy of that market is, right? As opposed to if you own a couple hundred units across the country, you're diversified by market exposure, right? By physical geographical location. You don't have that advantage when they're all in one physical location. Turnover rates and operating costs tend to be higher. At least the turnover rate thing we know to be true in a multi-unit. The vast majority, I don't know what the experience of most people is here on their single family type rental, single family townhome, condo, anything you own just one of at a time, right? But we have predominantly multi-year tenants. I would say that tends to not be the case as
My
much
average tenant is 10 years.
in
Right.
multi-unit, larger apartment buildings, right? Do you know what the average turnover is in your average building?
I think I read somewhere it's 18 months,
18
but I think that's trending up because of the demographic shift. You have more millennials that are renting, everybody likes the idea of mobility. So, for the millennials and for the baby boomers, the idea of staying in one spot is no longer attractive. So, they tend to be I think that's going up, but I think 18 months is what has been common.
And this is a negative that's not necessarily always a negative either. In order to make your improvements and raise rent, you do need some amount of turnover. So in a rising market, turnover is usually good.
Especially if you stay near 100% and turnover, the more opportunities you have to take that rent up without all the conflict of forced rent.
But it does require management, so there will be more of that to be done as turnover rate increases, right? Fairly straightforward. Cost of the asset usually more expensive. Yeah, obviously it takes a little more money from someone to do, right? A couple $100,000 townhouse, relatively easy to finance and understand. A couple $100 million apartment building, slightly different math, right?
Just more zeros.
But just more zeros.
Just need to
There you go.
Just the
right?
Yeah.
Honestly, like with apartment buildings, like all the investors in here, like, if you guys can find something where you guys can get a hard money lender, investors pay all cash and value add it and just refinance out of it, that's the best way. When we bought this 22-unit apartment building, it was on the MLS for less than 6 hours and we took it off. And then when we had an investor who charged us an interest rate, we showed him, it's like, are you guys insane? This is like a 1% cap rate. We're like, we get it, but look at what the rents are. I know these people are paying $300, $400. So the building we paid $980, we just appraised it for $2.5 million. So like, I think that like, that's like, once I refinance all of my stuff, that's what I'm gonna do is find stuff I can pay all cash for, use hard money, and then go out of it. But if you're gonna try to find something, you have to put 20% down. And then
Raise the capital.
raise the capital, it's no fun. I mean, 95 units is a lot. I mean, don't get me wrong, that's fun, right? But on the other stuff, and yeah, so I would just try to find stuff you guys can do value add to, just put it all cash. And it doesn't take much. Like if you guys just focus on voucher tenants, that's what I do. I have like the 130 plus units, 90% are vouchers. Rent's guaranteed, stabilized, get the zip code, and you can tell your investors what you're gonna make.
Do you have a lot of issues with the tenants or problems?
If I have 150 units and 90% are Section 8, what do you think?
No, here's what's so interesting is like there's a preconceived notion of that there might be problems, but it's not. It's like you could do the same due diligence. It's just that it's government backed. During COVID, it was great to have voucher tenants, right? I mean, majority, like the government just kept paying those things. And we had somewhere, actually, we just got the rent relief. I got a check for 25,000 where a person did not pay for months, and we applied for the rent relief here in Fairfax County and got a check for 25,000 from the bank.
Some of the voucher tenants are more sophisticated now that they're like, I want the tubs reglazed. And
Yeah.
also, I have 3 kids, and it's a full voucher, so we expect like an outdoor pool.
Yeah.
And I swear to God, that's what they told me. And she goes, and I would like a hose to connect to it, like a longer hose, so that it fills up the water. And also, we're not really happy with the appliances. And the lady's like, if you do all that, I just think for 5 years.
Yeah.
I'm like, lady, there's like 20 people right behind you that don't even do that shit. You know what I mean? So,
I thought I was gonna say, here's your hose.
I know, here's your hose.
But these things typically then, a larger building, not financed the way that you might be used to if you're a fix and flip investor, or you're using the BRRRR method or hard money or whatever. Pretty easy to get a loan, or if you're gonna rent it out for your first 10 at least, to get Fannie Freddie type of regular 30-year mortgage loans. Those are typically not what we're doing for multi-unit buildings. These are commercial loans with shorter AMs, shorter amortization
And it
periods.
doesn't have to be, right, Richard? It's like you can get some of the high loans for how long is the amortization on some of those loans?
Well, you can get a 10-year, 5-year Freddie, Fannie, something like that. The standard is 10 years, 30-year AM. HUDs that we do are mostly 35-year
Mhm.
and assumable.
You mentioned 7 years before, what, that was depreciation was 7 years? What was that you mentioned before?
Accelerated depreciation for the tax code. So you can accelerate the depreciation. So once it's all depreciated, or most of it's depreciated, people flip out of that property.
And this is probably as good a time as any to talk about it. Even if you're amortized to 30 years, it's great, you have a 30-year payment schedule. But your rate is locked for what's the longest you're typically getting on a 100-unit building commercial loan. What loan term is
Well,
common?
on Freddie or Fannie, like a 10-year term, 30-year AM, it could be, roughly, if you're a preferred borrower, it could be around 2.8 interest only.
At the end of that,
2.8 all the way up to like maybe in the low threes.
and at the end of that 10 years, what happens?
The term is up, it balloons.
Yeah,
You have to
the
refinance. That's
You-
why the HUD is better. The
Okay.
HUD is 35 years and it's assumable.
That's what I was,
So you
that's what I
can
was
have-
going to, right?
You can have that property, amortize that for, not amortize, but depreciate over 7 years, you still have 20-some years, 28 years left on it.
Of locked.
Of lots.
Of locked.
Fixed rate.
Right.
Wow.
Fixed rate.
So
Yeah.
that's a big deal, right? Understanding
Yeah,
right.
which kinds of programs your property might qualify for as opposed to a 5 or 10-year product where in 5 or 10 years with whatever the current rate environment is.
I've always worried
You
about
have to
that,
get another
right? It's like, hey, it comes like 5 years, 7 years, 10 years comes up and then what, right? I
Some
wanna,
people think that they're gonna fix it up and by then they're gonna blow out of that property. But it's nice to have that option.
Yeah.
So if you have, and the biggest difference, let me tell you, the biggest difference between HUD and Freddie Fannie, you have to demonstrate a net worth equal to the loan amount. It doesn't have to be in a 401k or anything that's liquid. It can be just anything on your balance sheet, like real estate, things like that.
Shiba Inu coin?
HUD, yeah, HUD, you don't need that.
Good.
But both you have to demonstrate experience.
Yeah.
But there are ways around it. You just
How long
maybe-
does it take to close a HUD loan?
That's the negative.
Yeah, I knew that was.
But the HUD loan, it depends on the region, like on the East Coast right now, it can take, I tell people straight up, it's gonna take 9 months to close. But if your seller is worried about closing, needing money faster, we'll do a bridge loan, bridge to HUD, do that way.
Also probably good just to refinance then with you then. If it takes 9 months, then to buy it and then refinance.
Yeah, that's what a lot of people do, once they're holding it, they're not in such a hurry to,
Yeah,
when it
refinance.
settles and everything like that. Once you get the application in, you lock it in, it's just a matter of, when it settles.
speed wins, right? So if you
But,
don't like
we can
cash,
do it, we can still do it fast. Our
Yeah.
underwriters are what are called MAP certified by HUD. That stands for Multi-Family Accelerated Processing. So they're MAP and Lean. Lean is for assisted living.
So with your 95 units in Lynchburg, you think your seller would wait 9 months?
No.
Just for you guys get denied on technicality. I think months into it.
What's the loan amount? What's the purchase price?
7 million
7 million?
is the purchase
What's
price.
the bridge loan?
We were able to find a credit union and we got a hold of the seller. He was flexible. He just wanted to close before the end of the year.
Okay,
So
that's
that-
understandable, right?
But to your point with other sellers, because I had to go through a lot of properties to find this one, which they typically want to see like 45, 60 days. There's also a tremendous amount of money that they want hard day one.
Sure.
I was talking to an investor, these were 200 and some units, but they need like $1 million hard
Wow.
to basically secure these properties.
Right.
So to go back to something that you did, that you mentioned, I want everyone to understand what you were saying, is that with speed, having investors that you can close quickly, proving out the business plan, because that would be the other hurdle probably for you, is to explain to a lender, hey, the rents are 500, but they should be 1,200.
Yeah,
know,
that's
a lot of-
absolutely true, because we can
Yeah.
only underwrite to the existing rent. I don't care how low it is, like 600, and it's worth 1,800. Sorry, I can't do it. I can't.
Yeah, that's why
I
you
can't
just
underwrite
pay, you can get all
1,800.
cash from an investor.
and then change it enough
Right,
advance
yeah.
and refinance.
Prove out the business model, then refinance it, pull your cash out at that point.
And here's another important consider, when you're underwriting this deal in Lynchburg, for example, or any of the deals, what is your average operating cost that you're typically putting into a building like that? Because there's always what they give you, and then there's always what's reality.
Yeah.
I found, right?
No, totally.
Yeah.
It's gonna vary, so the brokers always typically, and I don't wanna blame the broker. 'cause
Now, of
they're
course,
getting
they're
information from the
getting
seller,
people, but that, they're gonna
But they're
lower
always
that.
gonna understate the operating expenses.
Mhm.
In typical expenses, so if it's a class A property, you're typically gonna be in like the 30 to 32%.
Mhm.
As you move up to like a class B, it's gonna be in the high 30s to low 40s. If it's a class C, all bills paid, where the landlord's paying for all the utilities, you're gonna be upwards of 50%, maybe
Wow.
35%.
I want people to hear this. This is super important because I learned this the hard way, right? I was like, oh, I'm underwriting this at a 25% operating cost. So what that means is that's the cost to run that business. Think of it that way, right? Hey, there might be some, shared utilities that are there, like landscaping outside, painting, there's
Taxes.
there's a cost to running that business, right? And many times those brokers will give you the operating cost and they'll say, oh, it's only a 25% operating cost in this thing. In the beginning, I trusted that, right? Then I bought the building and then I'm like, this operating cost is like 45%, right? Building's older, it's class B. Now luckily separately metered units, it's another thing. You gotta make sure like, hey, what's separately metered? Is it, electric, gas? Water's typically common in a lot of these larger ones, right? You just have to know those things as you start going in and evaluating multifamily properties, which is very different than the operating cost of a townhouse.
In
or
this
single
case
family house.
too, it was an owner operated, so you don't know, maybe the guy's going in on the weekends and, putting the coffin,
And doing the work
Right.
himself and not billing it.
So one of the things that, and I think John did a pretty good job, so we decided we wanted to be in Lynchburg, we liked the market, we liked what was going on there. And he found a good management company, not managing his property, but actually managing enough properties in the adjacent community that we worked with them on the numbers, so we just pretty much threw away the numbers from the owner. And then we just put in our own numbers, everything from rehab, and then, of course, we started high, we had headroom. And then we just figure over time, as the property gets improved, that will come down to a more normal level.
Yeah.
But we work with our management company who will be managing the property
That's
to
a
help figure those numbers
brilliant
out.
way to do it.
But with the credit union, how much money did you have to put down? 20% or 15?
On this deal, it's about 25%.
Oof, that's a lot. Did you get the seller to hold any money?
No.
Another way you could have done it, and I know this all depends on the seller, but the bank does 75, and then you have the seller hold 10%, and you only have to bring 15, or you have the seller hold 15%, and you only have to bring 10. So the way we normally structure it, we go up to the owner, I love your building, but obviously we want to free up some cash to hopefully fix up and bring it up to, 2021 standards. If I was to give you 90% of the money, or 75 plus that, if I was to give you 90% of the money, would you be okay holding 10% or 15% amortized over a very short period of time? And I don't even mention the interest rate. Oh yeah, sure. But if you start off saying, oh, do you want to do owner financing? They'll be like, get the fuck out of here. You know what I mean?
That's what
I
it
don't
sounds
think they would be, but if you sit there, you say, what if I was to give you 85%? Like we bought a lot of properties, like I just bought a huge industrial building like that, and the guy came up. He was also fellow. He's a manager in a hedge fund. I said, well, what if I was to give you, 90% down, 90%, and then I hold 10%? Yeah, done. And then you just keep on and on and on. But I think that it's just easier because let's say you guys didn't have the 25% down to 7 million. What are you going to do then? And most banks, like a lot of smaller banks, won't take. They don't care as long as the person's in a second position and they're in first position and your debt to service ratio isn't crazy, they'll do it for you.
Great advice.
So the benefit there, they would only have to put 15% down versus 25.
Yeah, so they don't have to come up with 700,000 if they do 10% down.
Yeah.
And because it's not just 10%, then you have the closing costs, then you gotta then the rents and then the security deposits and then everything that's coming over, and then they always lie about how much money they're making when you get the rent roll. And you're like, oh my God, they said we're making 50, why is there only 30? Or 35?
No,
we just had a bunch of people move out right before you closed.
I
You know what I mean?
bought a
All my
little,
relatives moved out.
Yeah.
I bought a little duplex and the seller financed the whole thing. I just said, hey, what if I put down 20% and you owner finance the rest of it? And she just said, let me talk to my CPA. She came back, she's like, that's a great idea. I'd actually quoted, like, this was a while ago. I quoted, I think like 5.5% is what I would pay, right? And this was like 15 years ago. And she came back and she's like, oh, you pay me 4% interest. Okay, that's, I don't know if she heard 5%, 5.5% before, but you know, she owner financed that property for me for like 5 or 6 years and then I just ended up selling it. So, you know.
And
sometimes
another
just
option
ask.
is, we bought a property from a lady, she's actually a existing financial advisor. 7 houses on the property, she wanted like 1.8 million, she knew what she had, it was a really good piece of property off the face. Anyways, went up to her and said like, listen, like, you know, why don't you take 1.4 million, you know, amortized over 30 years at 4%, because that way your kids will have money, you don't get the big tax gain. She's like, and she's like, yeah, my kids are kind of, I'm not too optimistic on that. I'm not gonna be here for very long, you know what I mean? And I'd rather, you know, I get 4% on, you know, my 1.4 million and it's over, you know, I was like, well, we can balloon it. She's like, no, just keep it the way it is.
It's an annuity stream.
Yeah, it's an annuity stream. She's like, I talked to my financial advisor and that's a better way to go and do it. So there's,
Yeah,
it just
don't
depends on
affect
how
us.
motivated the seller is.
Yeah.
Now, I want to clarify one thing. I think before I told you that we have to underwrite to the exact rent numbers. That's for Freddie, Fannie, HUD. But we have other programs like stated income where you don't have to do that. They'll look at the market rent. So
Interesting.
that part will
So
work.
Mark's gonna have a conniption if we don't follow the slides.
Oh, we
I see
can.
what's going
The slides are just general reference, but I want to just reiterate something for those maybe here in the room and they go, this is all really cool. We can advertise and we can 7 years and then I can hold back. Cool, so I need to go out and buy a 100-unit building then and figure all this shit out? No. Your first multifamily unit can be a 2-unit duplex, right? You don't have to start with a 100-unit building. Anything with more than one door, right, is a multi-door, multifamily building. So where do we find then a good starter project, duplex, triplex, fourplex? type
Winchester.
Winchester.
Right?
Tertiary
absolutely.
markets.
Front Royal.
Winchester, Front Royal, Lynchburg, Charlottesville, Frederick, Maryland. College towns are great. College Park has a ton of multi-unit buildings, the vast majority of which are owned by individual people. Find a college town, find a farther out from the city college town, mostly in town stuff.
I own
It's
2
probably
college
the-
rebels. They would look like hell, but they made good money. I mean, I remember visiting a property and you've got like this beer, what's it called, like the whole funnel down the stairs and, you know, it was, yeah. it was-
Nice.
You've done a college town before, because the thing to look for, and I don't know if you've done it, are the leases. Are they leased per bed or per unit?
Yeah, ours were per bed
Per
and the
bed.
parents paid a semester in advance.
Yep.
Which is crazy.
Wasn't it exhausting with the turnover? There's a huge portfolio right now, James Madison, that's being marketed in my Marcus and Milkshake. They call me all the time about it. And it's like 100 something beds. I'm just like, I'm in full time, I gotta track down kids that fill these beds, you know what I mean?
No, they fill, the kids find them, the parents pay for them, it's
Like
not.
every 12 months or every 2 years, they gotta refill all these beds, it just seems exhausting.
Sounds like a good job for a property manager.
Yeah, it's not like a proper property.
Who is it motivated?
Okay.
So this is kind of stuff that we've been talking about, but anything more than, one of the other advantages, by the way, just starting out with a duplex, triplex, fourplex, all of those are financeable with regular old fashioned Freddie Fannie 30-year, just like your home loan kind of loans, right?
Yeah, Skylar, you could buy one as a primary, live in one side, rent out the other side, have the other side completely paid for the mortgage like that. You know, it's a form of house hacking, right?
And anyone here who has the economic, social, and just personal ability or willingness to do that should do that, right?
100%.
Especially anybody who's younger who wouldn't mind living with a couple of people either in, next to, above, around, whatever, while also being their landlord. Buy that fourplex, rent the other 3 out. live
Such
in
a great way to
person,
get experience.
Absolutely no cost at all.
Yeah.
So yeah, anything more than that though, and you're probably going to need those commercial loans that we've been talking about under those terms that we've been starting to discuss, right? We're saying 20% down, but apparently you can go as low as 3 on a HUD. What's the HUD?
No, but I think it has to do
You
with.
can't do a HUD a regular HUD loan.
Yeah.
85% LTV.
85%.
With no, you can't have a second lien, second position.
Okay.
On a stated income or some of the other ones, it's for the most part, stated income. You can have a second position like a seller second, something like that.
Okay.
And I think what Chad says is just excellent. That's the way I would approach it.
Mhm.
You know, tell them that, hey, listen, you know, excuse me. You parked in the money there, what are you gonna use the money for? If it's in the bank, you're earning next to zero.
Mhm.
And you're familiar with the collateral where you're selling it. So you can take a second lien position, give you maybe 10%, 8%, some figure like that. And they're usually good for that, for like a 3-5 year term.
A discussion we have a lot here, right, about how to talk to other potential high net worth people about perhaps funding the seconds, the thirds, the whatever, the equity portion of your deal that you can't get the main loan for, right? Topic
Yeah, I was
for
gonna
tonight.
say that really is the other way you can get involved in investing that was sort of hidden to me many years ago, and that's through a syndication. So I don't know if anyone knows what a syndication is, but that's to your point where you get the debt, when you look at the capital stack, you get the debt from the lender, right, from a credit union or Fannie or Freddie. And then to raise the equity piece, you put together a syndication, right, where there's a general partner and a limited partner. The limited partners are the passive investors. So you can get involved and get the returns because you're an owner as a limited partner in the
Think of
building.
it as like you're now an owner in a business. That's what it is. And you're getting a rate of return on that money that you've been, hopefully, right? And normally, they're gonna give you a preferred return as an investor. Might be 8%, 7-8%. And then after some work and 5 years and an exit plan, you might get then hurdles and, you know,
20,
above that
yeah,
20%.
typical would be 18 or 20% IRR. So you get a big chunk at the end. And then when you add up the cash flows, 8% preferred, plus the chunk at the end when you refinance or sell, those returns typically are 19-20%.
So that's how people take down big buildings, guys. You know, many times when I first started out, I was like, a $5 million building. I don't have the money for a $5 million building, right? But you don't need to. What you need to do is you have to have a business plan around that $5 million building that you want to buy, and you go out and raise capital for it, and that's what he's talking about. You have then, you're able to sell essentially shares in that little business, and you're giving people a return on that money. So that's how it's done. But the way that you start off in the beginning is just investing in one of those, right? That's a way to kind of look at the
We really
the
don't
business
raise,
plans.
you're really only raising the equity for like say 25%.
Yeah,
You know, because
25.
then you're leveraging it with the loan.
The
So
debt.
the partners, you know, who put the primary partners put the deal together, they find the property, they do all the work, they get the management company, they get the loan, we get all the pieces, and then the passive investors are really just covering, you know, that one equity piece. And then depending on how you do the loan, if you're refinance, you can sometimes take them out, you can give them a quick return, or you can carry them longer, just depending on the way the deal's set up.
Yeah, but where am I going to find people who are interested in investing in real estate that have high net worth and money that they'll give me for like an 18%?
There's a guy like Blair, like he's got a lot of money, dude. He's got it right there. That's where it is, right?
Surprise, surprise, it's here, right?
It's in this room. It's in the network. It's in the people that you know.
It's the reason you come to stuff like this. There are people out there who would love to invest in your real estate deal for an 18% secured return on real estate, right? Much easier than you might imagine.
Okay, that's a good
I think
point.
what you gotta point out is basically two structures, a 506 B and C. So with the B, all you have to do is like get a list of accredited investors, a lot of highly wealthy people. The C, you're basically marketing something, a specific property, which means that you have to have an SEC license, 7 to sell it.
Yep. The difference between an investor and securities, right? You shouldn't be selling securities without going through the proper channels. Really good discussion for a broader discussion on syndication, right? If you've been here before, we got
I
a
think we
good
did
buddy, John
syndication
Rubino.
2 months ago.
A couple months ago, covered a little bit of that, our buddy John. Rubino sets up syndications and comes in and talks about it. The short version is, with the right steps and the right document, and giving the correct and correctly packaged information to the right people, you can get money from private investors to cover the part that you don't borrow to buy your larger, more expensive building, right? So you don't have to come up with any of the money structured properly. So numbers we've been talking about, Rob, you talked about net income and kind of understanding true net income and real costs of multifamily buildings. Really kind of it's the same stuff, just more zeros, just the numbers are larger in a larger building as opposed to your little condo.
Yeah, we
that you
kept the
might
numbers
rent out.
really simple for everybody.
Trying to keep the numbers relatively simple, though. You've heard a couple people talking about cap rate or capitalization rate, right? You know, wouldn't it be awesome if we could just buy one of these? There's some market in the country, I'm sure, where these numbers are accurate, just maybe not here. But how you determine cap rate is just the net income divided by the purchase price of the property. So you talk about people selling a building, it's an 8 cap, 6 cap, 12 cap, 15. I only want to invest if I get like a 18 cap or whatever it is. Net income divided by purchase price. How you determine net income is you just take the gross income, which is all the rents that are coming in, and you start subtracting expenses. Typical expenses being taxes and maintenance and insurance and with facilities and roofs and all the other stuff that goes into maintaining and owning your building. Subtract all that out, get your net income divided by your purchase price is the cap rate. So in the example here of a property that produces $40,000 a year in income and has these other expenses resulting in a $24,000 a year profit, if you were to purchase this at $95,000, that'd be awesome. But anyway, 24 divided by 95 is a 25% cap rate.
Yeah,
If you find that, let me know.
Yeah, where was that property?
Those are awesome, but perhaps a little more common. Oh, here you go. Here's math that you might see a little more frequently. If it's a $400,000 sale price and somebody says, oh, I'm looking to sell this at an 8 cap, that means it should be producing $32,000 in net income every year, right? So you can work it from either direction. If somebody says, hey, I've got this cool building for sale and it's an 8 cap, and you say, well, cool, how much they want for it? You can do some math and see here what it should be producing in income. Your job then as the investor is to vet that income and expense stream,
which is what we're
to make
talking
sure that when somebody says it's an 8 cap, that it really is returning that 8%.
That's where you need to verify those operating costs.
Reagan said it best, trust but verify, or everybody's lying. Ooh, I'm on way too many
That's
slides.
okay, we don't need to.
Way too many slides. Look at all the fun slides I've got though, Rob. More cap rates.
No more slides.
It's just how you get determined at 15%. Cap rate just by the income. Blah, blah, blah. I just talked about that. There's more examples. Can't set the rental rate based on the cap rate, must be based on market rate. Yeah, so cap rate is what the property happens to make at whatever the current rent is, but you can't just say, well, cool, I want to make 15%, so I'll just turn mine into a 15 cap. You would have to raise rents, which is determined by your market, or lower expenses, which is determined by the quality of your facility in order to get there, right? So
This is a lot of what you guys were doing when you went to the property managers and you started saying, hey, what's typical income, what are the typical expenses, right?
what are the top 3 ways, the top 2 ways on the top of your head to make more money on a multi-unit building?
Yeah, and I feel like, and I hate to cut your power cut, but cap rate gives you a really good rule of thumb, but at the end of the day, your cash is your cash. You know, what you're gonna take out of the property is what's gonna pay the loan, the loans back. So at first, we had a deal, but then after that, it was all just sweat the details, because the lower the lower the expenses look, the bigger the return, but that's all BS. That's a pro forma. At the end of the day, we're gonna return 8% plus whatever equity piece that goes back to the investors. And that cash is going to really matter. So sweating those details. So yeah, so you can guess what's the cap rate, but in the end, there's what the expenses are going to be, what's the income going to be, getting that operating income, and then that's what you got to work with.
Yeah,
So
can you work with that?
we worked really hard. We worked those numbers very hard. Even after we had the contract to make sure we were comfortable that we could actually manage the property and get it out.
One thing you can do is you go to all those property managers in those areas and you say, hey, what are the typical rents, what are the typical expenses? And what are average cap rates for this market, this area? Because they will be different.
Yeah, that's true.
Baltimore
That's true.
compared to Lynchburg, compared to somewhere else, just to kind of get a baseline. That's what the slide is about. What's the baseline, right? So.
And I would say something you talked about earlier, there's 2 expenses so let's just suppose that you just bought a great deal, it's an 8 cap, right? And you think that's a great deal, the rents are about right. And then, but you're paying more, that the appraised value is something from maybe 10 years, it's a long time owner. So the tax values are much lower. So for a lot of jurisdictions, when you now pay $7 million for it, you're almost doubling and the taxes are reset every year. So you have to look at what the tax mill rate is for your value, and that could hit that year. Some jurisdictions do it every 2 or 3 years. You really need to call them to find out. But that could be a $35,000 hit to your expenses, which could wreck your cap rate if you think you're getting a really good rate. And then the second thing is insurance. Insurance, because of replacement costs right now, they're completely out of whack. So expect to pay a significant more in insurance. Again, the previous owner, just like the taxes, they have it underinsured. They're underinsured, and they've just been paying. And there's no good salespeople in the insurance business that call to say, hey, you really need, we need to look at the amounts you're insured for, because it costs more than $50 a square foot, and that's what you're rated at. You're laughing. You've probably seen that.
Absolutely.
So it's got to be. So those are two big expenses that, even if you think you're buying at a good rate, make sure you're thinking day two. Like, what are my expenses really going to be? Not just what they're telling me. And even the property manager, and we have a pretty good property manager, but there were some things that they didn't see that we brought up. So no one's gonna take care of your baby as much as you are.
Yeah,
So you
for
want to
sure.
be mindful of that too.
So I think whenever you sell the property, when the county assesses it, I think it has to be within 4% of the purchase price or something. I remember I forgot what it was. The guy called me because he called me about, oh, what improvements did you make? Why did it go for this price? And he said that when the tax assessment was the new price, I think it's within 4% of the purchase.
It depends on
Tax assessment.
It depends on the jurisdiction. And usually if you call the tax assessor's office and find out, but a lot of jurisdictions do it every year upon sale. So as soon as there's a sale, like, oh, you paid $4 million, it was previously assessed for 2.5, and then that's your new rate for the next cycle. So you just have to.
Can you imagine if you ran your numbers thinking that was a $2 million property though, and then it goes up to $5 million?
Yeah, it's crazy. Well, that's what he's talking about. It happens. right?
Yeah, I had a friend in Rochester, that exact thing happened. Somebody bought the property and didn't pay attention to this, and when they got their first tax bill, their property went from positive to negative. Poor guy now stuck with the property.
You know the way you can avoid that is I think one of the ways is if you bought the LLC. You
That's
bought the
true.
LLC from the person and you assume the thing, then you wouldn't have to worry about. I don't know, maybe you would, but I don't think so, because if it's like an if you buy the shares of the LLC, then you wouldn't have to get hit.
It's a creative way, there's trust and there's things you can do it, but as competitive as it is right now.
Yeah, I know, it just
a lot of
depends on-
sellers,
So let's talk a little bit about that, right? People are always like, well, how do I find these deals, right? How do I go about finding these deals, right? So let's just, how did you find your 32 deals this year?
Portfolio, so I talk to property managers. So most of my property managers, my goal is to become their #1 client. And then I say, if you have any tired clients or any clients that you don't like, that you think they should get out of the business, call me. And so literally, it's referrals from property managers, majority of what I buy.
Slumlord.
No, dude, that is such a great, and such great advice, right? Contact property managers.
And I'm willing to buy their entire portfolio, which means I'm buying the good, the bad, and the ugly. Blended average, it's a good deal, but it is much more of a hassle than a big building. But I'm able to parse off the properties that I don't really want, and that brings down my basis costs, in the long run. So I'm able to reposition from that portfolio after I purchase it to just the properties that I want.
How have you been funding these?
Most of it is cash.
Cash,
Yeah.
your own cash?
Yeah.
Okay, so there's the cash in the room, guys. Okay, so what's another way to find these deals?
I would say the multifamily space, brokers is a great source. So it's, if you go with multifamily, there's certain brokers that control certain markets, and they develop relationships with buyers. And what I would say, at least what I found, is that you have to, especially if it's competitive, you have to start bidding. Even if you don't really want the property, just show that you are interested in putting together, reasonable offers. And then what'll happen is you'll get outbid. Somebody will throw down $100,000 non-refundable, and eventually that will lead you to other properties where you get the right property at the right time, and they almost owe you one. So they will bring it to you as an off market, and that's really what you want to do. You want it off market, because if you wait until it's if they bring it through to market and do the full marketing, then you're going to be there with everybody else, right? It's going to be best and final. We're doing tours on these days. And it's just,
Yeah,
Yes.
well, it seems like it, on the commercial side, it operates a lot more like the Wild Wild West, right? A lot of these properties, that, you can look on LoopNet, like what other resources, but a lot of these are pocket listings. Like, these are just guys that have met the owners along the way, and for the right number, the right introduction, right timing, like, they'll do something. But it's not like on the residential side where everything goes out, the majority of it goes out on the MLS. It's.
And then once you buy one commercial building, like I always get a lot of brokers calling me, hey, we saw that you bought this.
Once they
apartment
know,
building." They'll
they
start
bring
calling
stuff.
you and saying, hey, and then I'm like, well, what's the cap rate? They're like 5. I'm like, it's like 8 or 10, you know?
Yeah, but they won't.
I don't care. I'm not in no rush. I'm not buying a bad deal.
Yeah, we go to Tennessee.
So you,
So find a good deal, go to Tennessee or the Carolinas or Florida or Ohio.
The problem is that, like with Mark Samilchuk and those people, I'm like, Fredericksburg, you want $1 million for 7 units, Fredericksburg, you know? And it's like one building, like, yeah, Jeff, we have out of town money, like we have
guys, the
Chinese
easiest way to do
people.
this too, just direct mail to these absentee owners, right, these owners.
Driving for dollars, right? Drive through that college town, look for that W4 or 8 unit building, get the address, look it up in the tax record, find out where the owner lives.
I do that all the
I'm
time,
looking to buy property.
right? True People Search is a place you can go, you can Google the name of the owner. I mean, it's easy to pick up the phone and just be like, hey, if you're thinking about selling, I'm interested in buying, right? It's such a non-threatening call.
Rob, what was John's name?
John,
John, what John told you guys, but you guys kind of missed it, was like, he just showed you guys how to become millionaires, but you guys, I don't know if you guys realize it. He told you to put offers in on properties, even if you don't think you're going to get it. And I've made so much, I mean, I don't know how much I made, but I've made a lot of money off of that tactic. Because you miss on a house, right? Or let's say, like for instance, I'll give you this one lady, she used to work with one investor. And that investor was like her rock star. She would buy the house, he would let her list it. That was her go-to. And that guy had done a lot of houses. So I came in, I put a backup offer. She was just humoring me. Well, that guy, he found out that there was a septic issue. He didn't do it, right? So I ended up buying the house, made $120,000 off that flip. Then she had another house. I just made $300,000 off that flip, right? Now, let's see what the next one she brings me. But if I didn't take his advice, which is putting an offer in and just humoring the lady and showing the proof of funds and showing that I was excited to do it, you know, then I would just, where would you be? You know, there's another lady, same thing. I just missed out on another house. I said, well, here's my proof of funds. Here's my thing. I'm ready to go whenever it is. Made another 80,000. So his advice, if you guys are paying attention, is really, really, really gold.
when you start getting really good at this, you understand every 10 offers I make, or whatever it is, you start learning your number, right? For every 10 offers I make, I'm gonna secure 1 asset, right? So then it just comes down to, it's a numbers game, just like it is in the agent side, right? X amount of conversations I have, or X amount of offers I make, I'm gonna have X amount of output, right, on it. So you said a couple things, that, make offers, but also build relationships, right?
And
Build
also-
relationships with brokers, investors.
In the owner, if you can, at least with multifamily, typically when you tour, the owner will be there. Make a point to meet them, shake their hand, engage in conversation, like build a relationship. Because if it ends up turning to a competitive situation, then you may have, a one up because they've met you. You're not just some guy from New York,
Some random dude.
right?
We also want to see if the owner's full of BS, and that's what, these numbers, numbers don't lie, but people do. I mean, so you kind of want to know who's the one generating.
That's true
the
too.
numbers.
Yeah, you can read them when you're face to face with them and see what kind of person they are.
Sounds a lot like conversations we have with sellers when we're trying to buy a house, right? Same kind of conversation. You're just talking to a person who happens to own a larger building with a few more doors in it, right? Okay, well, so we hit a lot of the things that we were talking about here. Hire a broker, drive for dollars, do your research, absentee landlord, right? Make a bunch of offers. Secure the property with a feasibility study. Can anybody get feasibility studies anymore? Maybe. Just enough time to go through some records.
Yeah, once
I mean,
you put your
if
hard
you're-
deposit down.
If you're gonna do a finance contingency, you might as well just wrap in the finance contingency as your feasibility study. I think it would be dumb if they allow you to do a finance contingency, don't put a study period in. You're just making the contract overly complicated for no reason, because you can always walk away with a finance contingency. So why do a study period? I think if you want to be competitive, I want a study period, I want an appraisal, I want a finance contingency, I want termite inspection, so get the fuck out of here. here? Like, what do you?
Yeah, but they may not let you on the property, there's
Yeah.
reasons why.
No, I understand, yeah, they don't want you to talk to the tenants, and who's gonna sell the building.
Yeah.
Yeah, I don't know if we want to talk about exit strategies, stabilize, add value, raise rent, sell for millions, right? Pretty straightforward, or just sit on the thing and make money. Nothing wrong with that either. All right, that was it for that thing. So fine, we can now dispense with the slides.
No more slides.
You go willy-nilly,
That's right,
talk
no
about
slides.
anything you want
Well,
relative to.
Yeah, I think the purpose of this, and it's good to have people back in the room, because it's been like, everything online, I'm like, dude, I'm done with Zoom. I literally just want people back in the room so we can collaborate and talk. So this really, at this point, is we stop going live, and you guys start to actually network with each other, hand out business cards, and what I found is that the real power is in the relationships of the people that you meet in here. You end up doing deals with them, raise capital with them, borrow money from them. This is how our world has opened up over the last decade. You know, all my investors are all my friends. These are people that I own properties with and have done deals with for 15 plus years. So power's in the network. Guys, thanks for joining us online. Bye. Asha, Vikas, everybody else that's on here. I don't know how many people came on. But next time, you guys should be in this room, right? And meet some more people, and we're getting back to the real world. So with that, Mr. Beckett, I think you could stop going live, Facebook, and all the rest. Thank you for joining, and let you guys kind of do your thing.
So tell